What's the difference between a mortgage broker and a direct lender? So we're going to cover that today, and the answers might surprise you. My name is Tim Diesel, and I'm a commercial real estate consultant, and this channel is designed to give you strategies and investment tips you could use in your business, or if you're a broker, you could definitely use in your client's business. All right, guys, so we're going to break them down right now. There are a few subtle differences, but then there's some that are really, really big and very important to keep eye on. Now, this always depends on the type of deal you have. So if you're buying a 10-unit apartment building that's $1 million and you're putting down 25–30% down, cookie cutter deal, you're a great borrower, this is no question. You're obviously going to go with a bank. And that's because you're going to have a lot more options in terms of rates, terms, however they want to structure it, the deal for you. Now, if your deal is a little bit complex, so let's take the same $1 million property that you're buying and you're only putting maybe 5% down, and you need to structure the deal a little creatively with some owner financing, that's when you're going to definitely want to talk to your broker. All right, so the biggest thing you'll notice is a broker has more programs. So they have a lot more programs, a lot more options. It's not very common for a bank to see a deal that they don't like or they don't want to participate in, and they're going to get creative with the deal, or they're going to make too many exceptions. Usually it doesn't happen. Most of the time it's going to be your mortgage broker that's going to take your application and they're going to shop it around to different banks and different institutions that'll do your deal. Now, the disadvantage with a broker is it's more expensive. Now, it is more expensive. Sometimes if you're doing a bridge loan, you might pay 3–4 points. Interest rates on these things are 9, 10, 11%, maybe more. That's kind of the downside. They're really more expensive, but they overlook a lot of stuff. So maybe your credit isn't the greatest, or your tax return isn't in line with what they want to see. They skip over a lot of that stuff because they're more concerned about the asset and how the deal's going to get done for them. So they're definitely going to be a little more creative. More creative and more open to your deals. You do want to make your deal work, because that broker is going to shop it around to 40–50 banks or whatever he's got, and he needs to structure the deal in the right way. Now, you must keep in mind that it doesn't always mean it's going to work, but you have a lot more likely. So if your deal is just not good to begin with and the thing doesn't debt cover, you're going to have a tough time getting your deal across. And I'll do a separate video for you letting you guys know what debt coverage ratio is in different terms, so you're more prepared when you're going to a bank and a lender. And now, if we're going to go over a banker, kind of giving you the highlights, a banker is going to be a lot more conservative. So if your deal is very easy to get done, you're going to take that bank the deal and they're going to look at it and they're probably going to give you a yes or no relatively quickly. You're going to have lower rates. And I'm going to put lower cost here because it's going to be cheaper all around. You're going to have your best rates at the banks, I mean pretty much always. They're not going to stick you with a bunch of points and fees, but they're going to scrutinize your deal a little more. They don't overlook a whole lot like they used to, where you might have more of an advantage with with a different institution, different lending institution. So in lower cost, I also mean the longevity of the loan. So sometimes you'll see banks want to give you 25 years. They might stretch out the term a little longer. What I have noticed, if you are going to go to a bank, you want to go to a smaller bank. So you want to go to a bank that's more regional. Maybe your regional or your local bank. So if you go to your regional or your more local bank, they're going to have more of an interest to work on your deal. If it's a small community branch, they're going to work with you a little bit more. If you go to a big bank like Wells Fargo or Chase, just those big boys, it's going to be a little tougher because a lot of times they won't even lend on certain asset classes. You know, some of them don't like multifamily properties. Some of them for retail, they're going to be very, very strict with you. If you're trying to turn a deal around, if it's warehouse office space, you might have some hiccups there. So it really, really depends. What I usually do, if I have a deal that's a little bit choppy, I'll always go through a broker and just kind of ask them, hey, what do you think of this deal? The only difference is they're more interested in getting it done. Where a bank, if they see a deal, they get a deal, they're not going to work on it so hard. It's kind of what I've noticed. Now, if it's a smaller bank, community bank, you're better off going with a smaller bank than going with a larger institution, definitely. I definitely want to say be very, very careful. Depending on your deal and how you're structuring it, make sure you ask both sides. Ask about a prepayment penalty or prepayment penalties. These can sink the entire deal in my case. Even if you get a great bank to give you fantastic terms, if they say you can't refinance for 5 years and you only need 2 years to turn your deal around, that might be a little scary. Whereas maybe you might have the same problem with a different lending institution, but you really want to get that up front. Figure out what the prepayment penalty is. I have seen some where they'll say you can't refinance the property, but you can sell it. And usually 1 or 2 years is not too terrible, unless you're doing something you have to turn around. Then you want to start asking about bridge debt or some other kind of private money or something else you can kind of do, private funding of some sort. Now, this also is not typically mean hard money. Hard money is also, it's a little bit different. This is just more for what they have available. So if you ask a mortgage broker, hey, is this hard money? Sometimes they'll say yes, sometimes they'll say no. It just kind of depends on what the deal looks like. So it doesn't necessarily mean it's hard money. It could be. Some bridge debt, almost, I think they're very identical to hard money. So it really just kind of depends. You only want to go for these guys if your deal is not a standard cookie cutter and you're not the typical A-paper borrower. So that's that should have broken it down a little bit for you. Hey guys, I want to give you a bonus tip here. No matter who you use, a broker, banker, hard money, whatever you use, make sure you ask them these questions. And I wrote them out here so you guys can take notes and replay the video a couple hundred times if you have to. Make sure you get these questions across. The first one is, what's the closing time? A lot of times you'll be talking to these bankers or brokers or whoever, and you haven't really gotten your deal under contract, but you want to feel them out. You want to ask them, hey, typically, how long to close the deal? They might say 30, 45, 60 days. Make sure you know that before you get your LOI or your contract set up, so you can get these terms in there. You can kind of get a better idea what they're doing. Their fees, you want to know what the fees are. Some loans, some banks, they'll ask for money up front. I'm not very comfortable with that sometimes. You want to know what kind of fees do they charge. Now, if they can get you a term sheet, a commitment letter, that's a little different. But you definitely want to know all the fees. Some charge you $4,000, $5,000 for an appraisal. It really depends, right? You have to know what they're looking at. And then finally, you'll have your combined loan to value. So you want to know what the LTV is with a second attached to it. So if they go up to 75% and you have the seller carrying 10%, well, that's 85%. Do they do that? And that's why you want to ask them about seller financing. So if they tell you they will do 5% extra or whatever, maybe concessions, however they want to word it, you need to know, do you allow for seller financing? Because if you have seller financing terms, you're in your deal, you're 2-3 weeks out before closing, I've seen it happen. They say, look, we don't do seller financing. We won't do a second lien position. So be very, very careful. These are questions you have to ask way up front before you even get into a deal. So your closing time, your fees, your combined loan to value, what is it going to be? And then you want to ask about seller financing. That'll help you put the deal together. My question for you now is, which loan would you take depending on your deal? All right, guys, that's all I got for you today. I hope that was helpful. Hope that kind of helped you break things down a little bit. Please like this video, comment, subscribe, let me know any other way I can help you. I'd love to do it. Thank you guys for watching.